Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, May 13th, 2026. It's 10:50 a.m. Eastern Time as I'm starting the video, so we're about an hour into the trading day. And what I'm going to do in this one is give you a trade idea, which I'm viewing a lot like crude oil, primarily as a hedge to any index and or semiconductor shorts, semis really being highly correlated with the stock market. And I'm going to get to those trade ideas in a second here. This is TLT. This is the really the 30-year. They call it the 20-plus year Treasury bond fund. When you trade futures, you can trade the 30-year bond. An ETF, due to keep expenses down, they can't every day. You buy a 30-year bond. A year from now, it's 29 years left to maturity. So they try to target the long bond, and guess they'll let it roll down, to at least 20 years. Just want to clarify that, but it is the closest thing to track the long bond, the 30-year bond. And for, ever and a day, I've been maintaining persistent and consistent that Treasury, we've just entered or finished at the COVID lows back in 2020, a secular bear market in interest rates, and began a new bull market. And again, that it's subjective if you want to, or it's debatable whether you want to call that subjective. By my logic, based on the primary downtrend line and price channel, you had a very clear price channel and interest rates on the 30-year bond. That was clearly taken out. And you also have the simple definition of an uptrend, which is a security making a series, as I'm circling here, of higher highs and higher lows. So that's every bit of the definition. And we could even come down here, and back test the trend line and go up and still keep that uptrend intact. But this was what we call a secular bear market in interest rates. There's not a doubt in my mind, nor there should be anybody with a financial background, that it coincided with the most powerful bull market in history. That's the biggest bear market trend we've had, at least in our lifetimes. Anyone listen to my voice, and this picks up. They only track the yield on this chart going back to 1977. That ended the secular bull market of rising rates, runaway inflation, all that. So that has been the fuel. And then at the tail end of this bear market, the analogy I use, kind of like, let's say you're a NASCAR racer, Formula One, whatever your cup of tea is in racing, and you're on the final stretch, and you're a lap ahead of the second place car behind you. The finish line's right in your sights, and then all of a sudden you hit nitrous oxide. You don't need to do it. But that's what they did, with the when COVID hit. You had this is the financial crisis. You had the first rounds of quantitative easing. Fed took down rates down to zero interest rate policy on the federal funds rate. And then additional follow-up bouts of quantitative easing every time the market even sneezed, hiccuped, looked like it might catch a cold. And then they hit the all-out nuclear button. So that's what, even though rates have gone up, and again, this is, I don't want to choose my words, perplexing at minimum, the fact that it hasn't had a bigger impact. But again, there was so much liquidity. It's mind-boggling, really, to get your head around the numbers, the amount of liquidity injected into the system at that point in time. And so either way, everything has a lag, just like when rates peaked right here. You can see as I take the line down, this is when the 30-year bond rates peaked back in 1981. There was a bear market that still had plenty left to go. It doesn't look like a lot. If I didn't make clear, that's the S&P 500, the white line there. And so there is always a lag, and it took, it was a good year plus. Anyway, so that's it. Now, okay, those are all facts. What I just covered, we can see it in the charts. What's going on. My expectation remains that ultimately we break out above this range. If we break out above it soon, and right now, the risk of a upside break, obviously is much higher. I have it circled, but we can box it here. This is where the 30-year bond has been kind of range bound for the last few years. And an upside break, as I've covered many times, won't just be a breakout to a 52-week high. It'll be, and not just a breakout to, multi-year high. It'll literally be a breakout to multi-decade highs. Yields not seen since immediately before the financial crisis and immediately before the dot-com bubble burst, the two real bear markets that we've had that were allowed to, I should say run its course, because the Fed came in heavy at the, financial crisis, backstopping the banks, quantitative easing, zero interest rate policies. But either way, it was every bit of a bear market, 55% drop. NASDAQ dropped 80% in the dot-com bubble. And since then, we've had, even COVID was a bear market by definition, but if you blinked, you missed it. 6 weeks, 36% drop. All right, so that's it, guys. Now, where I'm going with this, I'm going to segue into the NASDAQ 100 and SOXX semiconductors, but I want to put this out there that although my expectation ultimately, and it's a very long-term call, this is a monthly chart I'm looking at, monthly time frames. Every candlestick's 1 month. I drop down to a weekly. Here's what it looks like. You can see the range there. You had and do have negative divergence. Again, divergence isn't a sell signal that could send treasuries lower. And I'm going to give you a trade idea, and it's going to be either a pure play or a hedging trade idea. So now I'm dropped down to the daily chart, meaning every candlestick's 1 day. And you can see here, this is the yield. Again, we're not looking at the bond. We're looking at its yield, the 30-year bond yield, which is the opposite. Moves inversely to the price of the 30-year bond. And so you have this wedge type pattern right here. You have a divergent high, i.e. negative divergence. You had a divergent high there. Again, divergence isn't a sell signal. What is a sell signal is a break of support, just like right here. And that was also, although not labeled, it was drawn out. That was a divergent high. And that was a divergent high. And just like I like me some divergent highs, I like me some divergent lows. That was a divergent low, rally. Divergent low, rally. Again, I don't have all the, they're drawn out. I see them. And so these are the swings within the trends. And I'm going to drop it down. Let's look at, let me just cut to the chase here and give you a trade idea. I'll probably make it official, get some targets out. So now I flipped over to TLT, which is going to be just basically in reverse. And you can see here, drawn out on my daily chart, positive divergence as we come in. We're threatening to break out. Remember, if TLT breaks the recent lows, I'll go to a weekly chart. This is what it looks like here. TLT is an ETF, so it only started trading back in 2002. That's why I use the TYX, the yield of the long bond. This charting platform, that's what I could show you. So this is pretty much it. If TLT breaks down below these recent lows, the 30-year bond's broken out to new multi-decade highs, and I will eat my shoe if the stock market continues to rally, all right? There's no guarantees, but now, before that happens, and again, I think it will happen over time, but that's more of a macro, longer-term call. I don't trade or position off what I think is going to happen based on a monthly chart in a call that should play out over years, if not decades. That's just kind of, for what it's worth, stuff, 401k, long-term investing, planning to buy a house, a mortgage, all that kind of good stuff. That's where you might want to predict where the long bond and the 10-year bond is going to go. This is where I trade. These are all official trades. This is a 60-minute chart. This is as far back as I can roll right here into July of last year. And as I've talked about, we're batting well north of 800, meaning 80% or more success rate. Just been slaying this trade. And again, right now it's either a pure play or more so for me an indirect hedge for any index shorts or shorts on things related to the market. So what we're looking at here, you can see we've had divergence building here on this is the PPO making higher highs. You actually have, I should draw it out here fully. You had equal lows there on the RSI, and actually I can just take that line across. So this is it. So we've had positive AK bullish divergence building here. And that's my kind of setup. So this is telling me that although the 10-year bond has been in a downtrend since our last trade, I'll get to those trades in a second, it's setting up for a rally. Most likely. And it's not super well defined. See, I'm not in love with this because I only have a couple reactions. I wish I had a better defined trend line. With that being said, it can be a pure play long trade. I'm going to say this as I often do. Most people listen to I know this because I've run this site for 15 plus years, and I get very little feedback on the. Everyone wants to talk about the high flying stuff, the Bitcoin, gold mining stocks, the stock market, QQQ, the SOXX, semiconductors, whatever the hot thing du jour is. Bonds are boring. How many cocktail parties you went to and you started talking about the 30-year or the 10-year bond instead of Nvidia or AMD or Bitcoin, right? However, professionals trade bonds, I trade bonds, and the way to do it, because they don't move a lot in percentage terms, so they're not sexy, they're not exciting, but it's simple. You leverage up. Typically, I take about a 3-time position. I mean, 300% of what I might trade in SPY or QQQ, for example, because a big, a 1% move in the Treasury in the long bond is a pretty good move. It's comparable to about what you see in the stock market. 3% is your typical extreme. It doesn't mean it can't. I've seen days where the market's gone up 5 plus. But what's considered a big single day move in the Nasdaq 100 or S&P 500 is about 3%, and 3% is a pretty hefty move, and that's why I use about that 3 to 1. So my takeaway there is, if you put 3 times the amount and you're only targeting, let's say, a 5% profit on there, then that's really comparable to a 15% profit on a regular trade on the stock market, right? Because it's all about the dollars you make and the dollars you risk. Percentages are just a number, just that position size up or down. So the takeaway here is we're building divergence. I'm just going to review the last few trades. So going back in time, we went, and you can pull these all up. They're all archived in the completed trade section. So right after we shorted here, somewhere off the high, must have been probably right there on that break. We hit my first, second, third, and fourth and final target right here. This was T4. So we sheared almost all the meat off the bone on that drop right there, covering right here. I waited patiently and then turned it around. We ran it the other way. Somewhere here, probably on the breakout above there, I gave you a long. And we hit 1, 2, 3. I gave you a total 4 targets, but I decided to pull that target early on February 17th. So we hit T3, left just a tiny amount of meat on the bone, sheared almost all of it off, and now we've come full circle. So now my eyes I'm eyeing this one as the next long. And again, I'm going to get to the indirect hedging part in a minute here, I should say. Got to go back. I have to click on 2 hour to show you the previous trades before that, because I can roll back a little farther. So these are the last 2 I covered. Not exactly perfect, but near again, shearing off 80-90% of the meat and that's what swing trading is all about, just trying to capture the bulk of a trend. Before that, it looks like we had a short here, probably was a break on that trend line. T1 hit, T2 potential T3 hit, so we shorted it down there. You can go back a little further. I can see here would have been a break probably on this trend line right off that divergent high. And we hit my first, second, third, fourth, and final target right there. So we left a little meat on the bone, but again, that doesn't matter. I'm not looking to capture. It's nice when you get every bit of a move. Sometimes I'm just happy to get a good part of it and then move on to the next one. So, and you can see how well, just look at all these divergent highs and lows and then follow what happened. Again, this is not rocket science. It's just a security that trades well to the technicals. Now, this aligns with my outlook on the market. We're going to get to the market, and we're also going to get to crude. So my point about this being either a direct play long trade, if you are bullish, I'm going to show you the futures real quick for you futures traders. This is what I'll usually use, ZB. If you trade futures, I don't have to tell you this. There's enough leverage in there to hang yourself. So you don't need to make a lot on a 1% or 5% move in treasuries, because all futures contracts are inherently leveraged. They call that the multiplier. You take the price times the multiplier, and that's the dollar amount in there. So what you're looking at here, this is a 6-month chart with 2-hour candles. So similar to my hourly chart, there was our last divergent low, aka bullish or positive divergence, and you had a rally. That ended with, it's not, well, yeah, it is marked here. That was negative divergence here. You had about equal highs there. Then you broke the trend and sent us down here, and now we've come full circle. So we have positive divergence. If we go much lower, that divergence can get burned through. So I'm not in love with this. Like any trade, that's what stops are for. Where to? I haven't set my targets yet. Again, I want to get this out to you guys as I'm about to get into the indexes and the semis. But your buy trigger, you can see there's a well-defined trend line there. Let me drop this down to a 60-minute chart, and I'll show you if we can zoom in on that a little bit better. So again, just draw a downtrend line off the recent highs. You can see on the 60, you've got the divergence building here as well. And so that would be your buy trigger, is a breakout above the downtrend line there. And you can do a comparable downtrend line on TLT. Okay, so now before I move on to the stock market, the thing about this, just like crude oil, I've been talking about crude oil. Again, this market, in my opinion, is playing a game of Russian roulette with 4 or 5 bullets in the chamber, not one, trading at or near all-time highs with crude oil where it is. Again, that's my opinion, right or wrong, but I've been doing this a long time. I've showed you in the charts the impact that crude oil, once it hits that threshold number, has had. And and it's not always an immediate impact. There is a lag. And so as I've been maintaining, the longer crude stays elevated around, north of 90 a barrel, especially north of 100 a barrel, the bigger the impact it will have on the economy. That is not that's not a debatable opinion. That is fact. We know that to be, for all the reasons, that crude is very inflationary and constraining to high crude prices to economic growth. All right, so the point of this being, when you look at, let's go back to the yield. And again, I understand it's the 30, and not everybody borrows at the 30. Mortgages are pegged closer to the 10-year. We can look at the 10, but the 30 is well watched, and it's going to be talked about. As I talked about, the UK gilts just broke out their 10-year bond, and I think their 30 to rates not seen since the 80s. So they have broken out to their multi-decade highs. We're just right behind them here. So the way I view this is, like crude oil, we already have persistent and stubbornly high rates. Obviously, that's because it's twofold. It's what they call the bond vigilantes that are stepping in. And we have the Fed is inherently easy. I use the scorpion and frog analogy for Powell. He's a scorpion. It's in his nature, as every Fed chairman in recent history before him. He's like Lionel Richie, easy like Sunday morning. They want to be easy. It took everything in him to have to raise rates when they were in denial about inflation after COVID and runaway inflation, and then he tried to walk it back twice, those rate hikes, with rate cuts in the market through the long term, the bond market threw a fit both times, went the other direction. So, all right, so where I'm going here is if we go up much more, that will be talked about. It'll be all over media, and it has an impact. This is the 10-year bond. You can see the 10-year is also threatening to break out to multi-year, possibly even multi-decade highs. Again, there's negative divergence. I think it could send it down. I've covered this quite a bit, and I'm going to say it again here just to for those new. If the 10-year and the 30-year, we're on the 10-year yield right now. These are interest rates. If they do that, and I feel very strong on these convictions, right or wrong, I feel very strong, there's absolutely no positive scenario or reasoning that I can see for the economy and the stock market, including the AI bubble, because there are a lot of the companies The big companies like Microsoft and Apple, they're cash rich. They don't need to. They issue debt only because it's cheap. They've been issuing debt in recent years. They didn't need to borrow. They borrowed because the Fed created this reckless environment of free money, artificially low rates for a long time. So Apple, for example, who never needed debt, never needed to sell bonds years back, and after the financial crisis, started selling bonds at 2-3% interest rates, whatever they were, because they had a AAA rating, and they used the money to buy their stock back and run their stock up. Not that they needed it for capex, and one of their biggest problems was what to do with all the cash. Tech companies tend to be cash rich and lean on debt. The bigger established tech companies. So the rest of the world, a lot of big corporations are dependent on borrowing, and as is the consumer. We know that. So the 10-year, again, is what tracks the 30-year mortgages more closely to the 10-year Treasury bond. Car loans and all that are going to be on a little shorter scale, but same story. And so, again, talk to anybody with a financial background, especially in economics, and they will tell you there's no spin on higher rates being bullish for the economy or the stock market. So that if that happens, just keep that in mind. So where I'm going right now is every tick higher, we're getting to kind of to the orange zone with the red zone up here, if you will. I haven't color coded this one yet. Now, if rates do this, you can see that if we punch out and equal this high right here or make a marginal new high, that's what these purple lines show. It'll be a divergent high. I need to extend that one. And it would probably send yields down. And it's what I would expect to happen if we do. We get up here, I think the stock market's going to start correcting hard. And then you're going to see rotation out of stocks into equities. So there's two scenarios where rates drop, whether we go higher first or not. Where this is only one scenario, in my opinion, and that is stocks down. Hard stop. No other scenario that I see. There's two possibilities. You can have falling rates from a big drop in the stock market because you'll get institutions rotating out of equities into the safe haven of treasuries. When they buy treasuries, that causes the prices to go up and the yields to drop. So that is a bearish for the stock market, but bullish for treasury bonds, right? And prices, when I'm talking now, remember, this is yield. Yields go down, prices go up. This other scenario is a natural abatement, natural market forces. In other words, inflation goes away, crude drops. Iran and Israel and USA start holding hands together and singing Kumbaya, and everything's good, and the strait opens up, and all this oil comes gushing out of there that's been backlogged, and crude prices drop. That is going to be, you would see inflation expectations drop, and the long bond would drop, and that would be supportive of higher equity prices. So, I'm just telling you, there's two scenarios there, and that would be yields down, bonds up. And so, again, we're looking shorter term. I just showed you the setup being bullish, indicating we may get the next rise in bonds. Now we're going to segue over to crude oil real quick. As I've talked about with crude for a long time, I've given you my zones. And since was it right before or right after the invasion, we've had 3 spikes. Let me go to crude futures. It's just a cleaner chart to me than USO. I've talked about my preference for hedging any index shorts with a short on crude, because if crude drops, as it did here and here, the market will rally. So you will profit. You will lose on your market shorts, but you will profit on your crude shorts. It worked extremely well here. It more than offset any gains. I measured it at the time for you when it did it. And then so kind of been in and out, kind of managing, throttling, if you will. So now crude's getting up there again. We're up again today. We're now to 103. We were at 102.50, I think, yesterday when I covered. So we're getting back into that area where crude may keep going up, but it will have an impact sooner than later. And again, it's an incremental. It's not a binary number. I wish I could tell you if crude was over 102 or 99, stocks go down. It's incremental, and the higher you go, the more of an impact it's likely to have on the economy and the stock market, right? So there it is. So now some of you may not be interested in being short or taking any shorts anytime soon. I'm going to get to the semis and QQQ in a second. They didn't close below those trend lines yesterday, but they're sitting right on them right now. And so that's it. So these are this one, the only, as far as buy and sell signals go, I gave you that uptrend line yesterday. We're still walking above it. I'm trying to draw it here on crude futures right there. A break below that could trigger a pullback, but it's been kind of in a very sloppy-ish range. So it's more of a, here's the high range. Once it starts dropping, gets down here, the market gets happy and giddy. And, if it drops below there, again, there's other scenarios too. This, just like treasuries, just like what I went over in treasuries. Here's the recent highs in crude futures. And from here, especially break out to those highs, I see one and only one likely outcome for the stock market in the economy, and that's down. If crude drops, again, it could be due to demand destruction. It could be to the Strait of Hormuz opening. And so the Strait of Hormuz opening and natural, just, the spigot opening back up and everybody getting their, oil reserves replenished and the prices of gas falling at the pumps, that would be supportive of for equity prices. Net bullish. Doesn't guarantee they go up, but it should. Market should like falling oil prices if it's a natural, organic, abatement. Or there's that whole demand destruction thing, and it's going to take the stock market going up. The stock market dropping quite a bit. So at some point, whether, guys, it's 2 weeks from now or 2 years from now, when the stock market is in bear market mode and it's dropped 20, 30%, you will most likely see crude oil going down because of demand destruction. All right, so that's it. So there's your trade ideas. Now we'll get to the nitty gritty of the QQQ. So I've been continually harping on the benefits, the pros and cons of waiting for daily breaks. So yesterday we had exactly what I've been talking about. There's an intraday. This is QQQ daily chart. This is a super duper well-defined uptrend line, lots of clean reactions. I always say trend line drawing is an art, not a science. The way I draw it, I like to capture the most number of reactions on either the bodies or that's the fat part of the candle, or the shadows, that's the skinny part. And so on an uptrend line, the shadow down below is called a tail. Up above it's called a wick. And so you can see we have numerous reactions along here, including yesterday. And so the shadow tells you the story of what happened intraday, and the body tells you what happened at open and the close. That's how if you're not familiar with candlesticks, please read up on them. They're, to me, just amazing. They work great for technical analysis. There's a story of 4 parts in there: the open, the close. Those are the 2 ends of the body. And how high it got intraday, that's the shadow or the wick up top. And the shadow, the wick down below, the tail shows you how low. And so all that was is an intraday move below, only to close back above. And as I said, both with semis and QQQ, you can get an early jump by shorting a break intraday on the 60-minute charts, or you can wait for a close below. And that's what I mentioned on the SOXX trade. So there it is. So no sell signal on the daily, sell signal on the 60, yes, because we went down there and had about a 60-minute close or 2 below, but went right back above it to close back above it. So that's the kind of whipsaw I'm talking about. And SOXX did the same thing, broke down intraday only to close back above. You can see here on the daily chart. Beautiful, well-defined. This is the uptrend line that we're watching now. Waiting for the highest probability entry is a daily close. And as I like to say, the redder the better, meaning, if you have to squint to see it, let's just for kicks and giggles say we close today, this candle right here, give it the benefit of the doubt. You're in an uptrend. If you have to squint to see zoom in to see whether you're above or below the trend line, you don't have to squint yesterday. We clearly closed back, hammered back above the uptrend line. So still waiting for that daily close below that uptrend line on SOXX. So the takeaway is, if we get it and you enter, or maybe you took it and that's fine on the 60-minute breakdown yesterday, a partial position, told you would have been my preference if you do that, not to go aggressive. And this has been a resilient trend. People, the dip buyers are foaming at the mouth. We know the retail crowd is fully engaged. That's been documented in the media very well. A lot of retail folks buying the dips, and I'm sure some institutional traders. But that's it. So if we get the sell signal on SOXX, you have all these targets down here. If you wanted to hedge in case we do get, let's say, a daily close, and then it turns out to just be a little dip, a little correction. Let me go back to the 60-minute chart. Let's just say like last time. Remember the last SOXX trade? We hit, this was our first target here. We shorted it there, hit the first target for like a 3% profit, and then we got stopped out. After that, it ran up and never hit our final target. So let's just say it does something similar again, right? We go down, we hit T1, which from where we're at right now would be a drop of about 12%. We hit T1 again by having a long position on Treasury bonds right now. If we get a 12% drop in the semis, I can all but guarantee you're going to have a comparable or similar. It won't be 12. It'll be a little less percentage terms. You'll get QQQ to fall as well. Might be about right here, somewhere in there. I'd say about that 6. I would say that's what it would be. If we'd hit T3 around that same time, about a half a drop. Because remember, the NASDAQ 100 is diversified. You've got Costco in there and, all kinds of companies that aren't semiconductors. T-Mobile, Pepsi, you name it. So all different companies. So you're going to see about, probably twice the drop in the semis percentage term. And you need to take that into your position sizing. And if you do go to SOXX, factor that even in more, the 3-time or 300% leverage. All right, so that's it, guys. It's pretty simple. I'm waiting for... still waiting for daily closes below both QQQ and SOXX. And I said in SOXX, that's not a short unless you see a comparable breakdown in QQQ. You got to see it. The semis are only going to go so far down without QQQ also breaking down with the big MAG, 7, 8, 9, 10, whatever you want to call them, stocks. So that's it. So there's the trades de jour. Setups in QQQ and SOXX. If you took it as an active trade on the breakdown, I'll consider that. It's semantics, whether you took it or you're waiting for the daily close. There's still your targets on QQQ. I still very, 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 very much like these setups from an RR perspective. What does that mean? What are you talking about, Randy? They break down a little whipsaw yesterday, won't go down. Again, I'm talking profit potential to loss potential. And don't give this one a 2-to-1 RR. There's not any reason if you're targeting T6, 31% drop, don't give it a 15%. It shouldn't. These things are ripe to break down soon. If they don't, there's just something else going on. But again, they're on the verge. The charts, everything I'm looking at here, you have extreme overbought conditions, divergences forming. On the daily chart, when I look at so many key semiconductor stocks and big tech stocks, I see the PPO is ready to cross what I call a high-level bearish PPO crossover. We haven't had those in a while. They work very good as trend indicators. Here, I'll show you. You just throw up a PPO histogram as the way to see that. And the histogram, these green and red bars, indicate when the PPO makes a bullish or bearish crossover. This is your PPO indicator. So when the blue line, the PPO line, crosses its signal line, that'll be a bearish crossover. Now, the SOXX is hard, it hasn't had a big correction in a while, but even the shorter term, corrections within there are marked by, often come and are marked by those PPO crossovers. So they're, these are all double-digit drops. Don't get me wrong. It's just been a big mega trend. And like I've said in recent videos, the parallels to the semis right now, right there, this vertical advance, and what silver did before it crashed, biggest drop in half a century, is they mirror each other. So like I said, I'm not going to give up on this trade. You're going to hear about it every day, and I'm going to keep taking shots till we get this one. And I'm also going to continue to spread my bets. I also have core positions in the ag commodities, and natural gas is still attractive right now. Put in that divergent low. You can see wheat's been really taken off. This has been my, of all the grains and all the ag commodities, my top pick for a while as a bottoming play based on the long-term charts. If you're new to the site, I'll cover these soon. I have a long-term, I think it's like a 30, 40-year chart on wheat. Just making the case that it's just, started a new bull market. What else is there? That's it. Let's just stop it here. So there's the takeaway of this video. Whether you are short now or plan to short, SOXX will just be probably about a 2-to-1 performance when we do get the next drop versus QQQ. QQQ, you're more diversified, not as concentrated. And then to hedge those up right now, short on crude oil and a long on treasuries. And of course, any or all can be standalone trade ideas as well. And so I will get out some price targets. I showed you we don't even really have the buy trigger on treasuries yet. We have the divergent low forming, but I gave you a pretty well-defined uptrend line. And I'm going to right now just finish the video by telling you, here's the way I can almost tell you it's going to happen. Again, that's why I call the site right side of the chart. I have a big margin here. Most charts end right there. This is current price. Anything to the right is a future. So I'm going to tell you my guess, right or wrong. I don't mind eating crow. That's what you got to do in this business. Take your shots. Nobody bats 1,000. But when you get this, a clear breakdown in QQQ, and you get this, a clear breakdown in the semis, you're most likely going to get this, a breakout in TLT. I give you a short-term trend line on the 60 to get you in early. That was on the futures. That's right here. This is the one I just drew on the futures earlier on ZB, the 30-year bond. So that breakout, and then you have this secondary trend line right there. And so it may not be immediate, but it should follow. So stocks will start going down. Institutions are going to take profits and get out of semis and tech stocks in order to cut their losses, and they're going to rotate into treasuries like they usually do. That's my guess. And look, guess what? The thing about indirect hedges is you can be wrong on one or two. Right now, like I said, we have 2 indirect hedges against index shorts and semi shorts. And if I'm lucky, which has been more lucky than unlucky lately, they play out. Like I said, I've had multiple shorts on crude when it gets in this high end of the range that have worked out great and really helped to offset or even turn to net profitable, because I haven't had full or heavy positions on index shorts in a while, and we didn't short until just recently. We had a QQQ trade, one SOXX trade that was stopped out, and a couple weeks ago, again, after already hitting a first price target. So, all right, let me stop it here. I'll continue to hunt for trade ideas. There's a lot that I'm seeing. I did an update this morning. I started in pre-market on all the short trade ideas on the site, the active ones, the official ones, but the dang video went over an hour. So I'm trying to keep those times down. If anyone wants to see it, I'm glad to post it. There's basically all the active short trades on the site, if you go into the categories, are still in play. Almost all of them are profitable. They're just taking a long time to play out because this market is topping. It doesn't look like it. You're going to say, what are you talking about? We're at all-time highs. The indexes are all-time high. The stock market's not, and I've gone over that. And that's why we have a lot of short trades on the site that are active short trades. Go here that are have already hit profits. They're just taking a long time to play out to hit the next targets. Again, if you're interested, I'll share that with you. But otherwise, I'm going to redo that video and update all the short trade ideas, at least these active ones. And remember, 80+% of the trade ideas I share on the site are in video formats, and I cover a sector. I'll cover dozens, and I don't put them all in here. So these are just the ones where you can see screenshots of charts with price targets and suggested stops if they have any. And pretty much, I think they all look good, and some of them currently offering either objective short entries or re-entries, those that have already hit T3, 4, and bounced. Others are setting up, and I can define, and I do in the video I did today, but again, it's too long. I'll just ask me, and I'll post a link if you want it. If you're a glutton for punishment, I think it ran 1 hour and 14 minutes. That's why I said that's too long, because I started talking about the stock market and other things. All right, let me wrap it up here, and I will get to a more concise update of these as well as the long trade ideas on the site, and I need to make sure I've updated. None of these have hit either hit the final target or the suggested stop. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.